Thank you. It's recording now. I'll try to remember to do this at the start of class in the future. It's definitely a good idea to get that going before we start getting into Excel. Any questions on calculating returns?
I don't have a question, but could you go over that again while it's recording now?
Sure.
Thank you.
Yeah. All right. So to calculate the return, we're going to follow our formula up here. So we start off with the price that we sold out at, $135.50, minus the price that we paid, right? We're not dealing with any dividends here, just simplifying it down. And we divide by the price that we paid. And so we have a total return here on our investment of 414%. All right, so how much money did we end up with in this investment? So we take our percent return, multiply it by our initial investment to get our total investment value of $10,900. So important distinction here, right? Our percent return is independent of the number of shares we had, right? That doesn't matter. Regardless of whether we had 100, or 1,000 shares, our percent return was 414%. What is relevant, though, is to our overall investment value, right? Our investment value changes depending on whether we had 1, 100, or 1,000, right? But it's proportionally the same because we had the same percent return on all those different values. So that's why percent return is so valuable, is it's regardless of scale we're dealing with, right? All that is relevant is the value of the asset we're dealing with, not the number of assets we hold. That's why one of the reasons we use percent return as our metric of measuring value. Any other questions on calculating return? All right, then go back over to PowerPoint here. All right. Time value money. Actually, this is probably a good point to start recording. This is the most important topic, in my opinion, in finance, and it's something that we're going to be going over basically the rest of class now, and also tomorrow, and something we're going to be relying on pretty much throughout the rest of the term. So, time value of money. What is time value money? What are we trying to estimate here? Right, the value of an asset is the discounted expected cash flows that asset is going to be generating. So time value of money, all we're doing is adjusting the perspective on when that cash flow is occurring to understand the trade-offs and value of that asset over time. All right, there are 4 things that we can calculate with time value of money. We can calculate the present value, so how much our future cash flow is going to be worth today. Generally, when we're dealing with present value, we're making decisions on whether or not to make an investment. All right, so with present value, we're figuring out what something is worth today and comparing that to the cost. Future value, we have some cash flows that are occurring today and through the future, and trying to figure out how much those are going to compound. Right, so that's going to be something like, how much are you going to have in your retirement account? These are the 2 main aspects of time value of money that we're going to be concerned about: present value and future value. Right, that's pretty much what valuation is about. How much is something worth today? When we say that, we're talking about the present value of an asset, and that's basically what your project is going to be based around, figuring out what the present value of an asset is. Right, the challenge in doing that is figuring out what are the inputs we need to actually calculate that present value. Right, in these examples we're going to be looking at, it's going to be relatively easy, but when we actually go and look at a company, putting together their cash flows, putting together their discount rate becomes a little bit more complicated. Right, so present value, that's how much something today. Future value, how much it's going to be worth compounded into the future. We can also calculate the number of time periods are needed for an investment to reach a certain amount at a given rate of return. And we can also calculate the required return, which is, what return we should receive from an investment over a given amount of time. So the number of periods is usually known or assumed, right? When we're dealing with something like bonds, those are a fixed income asset, and they have a fixed number of time periods that we're dealing with. When we're dealing with stocks, very often we assume terminal value for that stock, which means that the company is expected to go on indefinitely. We can also use a buyout approach for estimating the value of a stock. Usually that is going to be somewhere in the 5-year range for the value of that stock. So the number of periods is usually going to be known or assumed ahead of time. The required return, as we'll see a little bit later on in the semester, is going to be calculated a little bit differently. But we can technically solve it just using the time value of money problems. All right, so when we're dealing with time value of money, we need to have 3 out of 4 of these inputs to solve for the other. Generally, we're going to be solving for present value or future value. All right, so when we're looking at time value of money, what are we talking about? Right, generally speaking, money today is worth more than money in the future. And we can go backwards, right? Money in the past was worth more than it is today, right? It's not uncommon to hear grandparents or older family member talking about how expensive everything's gotten, how much cheaper things were in their day. That's 100% true. Things were on average cheaper. Right? If you look at the Bureau of Labor Statistics' first report of data going back to the 1920s, if you look at the price of grocery goods relative to today, they're a fraction of the cost. Right? That's a component of time value of money. Values of things change over time, and we have to make adjustments to time so that we can get an equivalent basis to judge the value of something. So that's what we're dealing with when we're discounting future cash flows. When we're trying to get the present value of something, we're trying to have time equivalent basis to judge the value of a cash flow. All right, so this is how we're going to be calculating present value. We get the future value of an asset. We divide it by 1 plus the discount rate and raise it to the number of time periods between the present and the future value. All right, so R is going to be the discount rate we're using, and is the number of time periods between the present and future value. The way that we solve time value money for all the other inputs is basically just by rearranging this. All right, so the future value is going to be how much money we have today times 1 plus the compounding rate in this case, raised to the number of periods, the number of years between the present and the future value. All right, so these are the 2 main components of time value we're going to be concerned with: present value and future value. I'm just going to show you and the number of time periods just for the sake of having it out here. Again, these are all solved by rearranging that original time value of money formula. All right, so to get the number of periods, the natural log of future divided by present value divided by the natural log of 1 plus the discount rate. And if we have to figure out what rate of return we need to generate to have some present value equal to some future value over a given time period, we take the future value divided by present value raised to 1 over the number of years. All right, when we're dealing with Excel, there are functions embedded in Excel that will calculate all this for us without having to memorize the formula. It is important that you do memorize the present and future value formulas. Those 2 are just fundamental to the field, so it's important that you memorize them right off the bat. But if you ever forget in a given moment, Excel can handle it for us. All you have to do is know that you're typing in these letters here: PV, present value; FV, future value; M per, number of periods; R, rate. Right? And once we open up these, Excel is going to guide us and tell us what information it needs to input into these functions to calculate the present value. And Excel is really an incredible tool to be using in the field. People that used to have to do this by hand had a really rough time of it. All right. So now we're going to go back over to Excel and work on some examples. All right. So let's say that we have $1,000. It's going to grow 10% a year for 5 years. What's the investment going to look like at the end of these 5 years? All right. So in other words, we're trying to figure out what the future value of this $1,000 is. All right. So when we're dealing with time value of money, today is represented by time 0. All right. So time 0 is today. This is the time period that we're either discounting back to or starting to compound from. All right. So time 0 today. So this then is how many years into the future we're going. So if you think of time 0, right, what this means is how much is $1,000 worth today? It's worth itself. It's worth $1,000. All right, so you have to start adjusting for the time value effects now. All right, so it's growing at 10% a year. So we can do that here. So we'll have $1,000 times 1 plus our growth rate. There we have it, 10%. If you're not familiar with Excel, you can hit key, what is it, F4, and that'll fix your reference. Actually, let me show you what happens when we don't fix the reference. Right. So what I did here, just to show the growth rate, is we took the initial $1,000, multiplied it by 1 plus the growth rate to get the next year's value. Right, 10% times 1,000 is $100. So we have that $100 plus the initial investment of 1,000. So we ended up with 1,100 in that first year. All right, so now we're going to go into the next year. All right, so with Excel, we can just Control C, then Control V to paste over. But notice something iffy went on here. Right, we went from 1,100 to 1.1 million. All right, so what happened was we did not keep our reference anchored to this 10%. So if we ever want to keep our reference fixed to a particular cell that we're dealing with in Excel, you hit F4 on your keyboard. If your keys are messed up or something like that, you can manually type in a $sign in front of the column and in front of the row. And then that'll fix our reference. So now when we paste over to year 2, all right, we're still referencing that 10%. So now we're going from year 1 to year 2. Our $1,100 is still growing by 10%, but it's grown a little bit more than $100, right? It went from $1,100 to $1,210. That additional $10 is now that compounded interest. It's that $100 that we got in that first year compounded by 10%. So now we see that as we copy this over into each future year, growing by a little bit more than the previous year, dollar-wise, right? So in this first year, we grew by $100. In the second year, we grew by $110. In the third year, we grew by $101. Right? So we can keep pasting this over and see how much this investment will grow by over 5 years. So if we start off with $1,000, put that money away, it grows at an average of 10% a year for 5 years. At the end of 5 years, that $1,000 will be worth $1,600. All right, so now basically what we just did was manually calculated the future value problem here. All right, so what we're going to do now is we're going to calculate this future value using the time value money formula. All right, we take the present value of $1,000, multiply it by 1 plus our 10%, and raise it to the number of years that it's being saved up for, 5. Right. So using the future value formula now, we got the same exact answer that we calculated manually. All right, so we start off with $1,000. It's compounding 10% a year. We can see that happen. But now, if we just want to know what that terminal value is in year 5, we can use the future value formula to calculate $1,610. All right, so this is what time value money is trying to do. It's trying to figure out how much a given amount of money is going to be worth over how much time and at what rate is it compounding or discounting at. All right, so if we start off with $1,000 growing at 10% a year, after 5 years, it's going to increase by more than 50% to $1,600 in 10. On the flip side, right, if we're told you're going to receive $1,600 in 5 years, what's that going to be worth today? Right, we should see that it's going to be worth $1,000 at 10%. All right, so using the present value formula, we're just going to be working backwards here. $1,600 in the future divided by 1 plus our discount rate. And we do. And so this is the link with the time value money that we're dealing with. Money, different amount over time. We have to make adjustments for the timing of that money. Money is worth more now than it is in the future. It's worth less now than it was in the past. So we have to adjust for when in time a cash flow occurs to have an equivalent basis to judge the value of that cash flow. In other words, right, when we're looking at the value of Apple, Do you think it makes sense to compare a company today to a company, that same company 10 years ago? Probably not, right? Most companies change over time, and it's important that you judge a company how it's doing today. On the same basis, we have to judge the value of an asset at the point in time when we're evaluating that asset. And that's what we're doing with the time value of money. We are adjusting for the timing of when that cash flow occurs.
Dr. Jansen,
Yes.
quick question. When it comes to compounding, so it doesn't have to just be like, say, like the returns. Like if we say like inflation, how does compounding and inflation work? Because if you happen to know, like, do they do it like monthly, like compounding with inflations, or like I figured inflation also compounds over time too, just like
Yes. Yeah. So inflation would work the same way that we're dealing with this growth rate here, right? So if we want to look, if an asset is growing at the rate of inflation, usually it's somewhere around 2%. It's been much higher over the last year.
Would that be like that 2%? Say if you had to like, I guess that 2% would you consider that like annualized like inflation rate? Like if inflation are like, I guess by the month, do those months like, I guess, compound over like within like the year, like kind of like?
Yes. Yeah. So you're actually bringing up a point that we're going to be getting to in a little bit. Right now, we're just dealing with annual levels of growth. There are ways that we adjust those annual rates of growth for smaller chunks of time. And we'll get on, I don't know if we'll end up getting into it tonight. If we don't get to it tonight, it'll be next week that we'll be doing an example of just that. But yes, right. So we are dealing with just annual basis right now. That's going to be another step that we're going to be adding to this later on. Right. So in this course, usually I'm generally going to try to start at the simplest way to show something, and then we'll be adding on more details to it over time. Right. But fundamentally here is the basics of time value of money. What we're trying to do is link the value of an asset across time, right? This is the same lump of money, right? We put this money into an account. It's growing at an average of 10%. After 5 years, it's worth $1,600. Right? If we were to look at this account from today, that $1,600 should still be worth $1,000 today if we discount it back at that same rate of 10%, which is what we do and what we find. Present and future values are mirror opposites of one another. Right? When we're calculating the present value, we're looking at some future cash flow, in this case, the $1,600, and we're discounting it back to today. When we're dealing with the future value, we're looking at how much we've saved up and compounding it into the future. When we bring inflation into the play, that's basically the difference between nominal and real asset values that we're looking at. Typically speaking, people ignore inflation, typically embedded in the growth rates we're dealing with. We can adjust everything for the real growth rate. All we would have to do is basically subtract out the inflation rate from the growth rate we're dealing with, and that gets you the real rate. But typically people ignore that because one, it's an extra step, and two, you get the same answer whether or not you adjust for inflation or not. All right, any questions on this example? All right. Oh, forgot to answer the. All right. So when we're dealing with present values, right, usually it's going to be a buy or sell situation, or buy or don't buy, invest or not. So let's say that the price of this asset is $1,500 today. All right. If it costs $1,500 for a $1,000 valued asset, should we make that purchase? In other words, we have to pay $1,050 to have access to this future $1,600.
No, because the present value is only 1,000.
Correct. Yeah. When we're dealing with present values, usually what we're going to be doing is comparing that to the cost of having access to that future cash flow. Right. So if the cost to have access to this future cash flow is $1,050, that's telling us that it's $50 costlier than it's actually valued today. Okay. So in other words, no. The cost is greater than the benefit, so we shouldn't pay that cost. All right. Berkshire B shares are trading about $300 right now, and analysts expect the price to increase to about $350 in 2 years. If the discount rate that we should apply to this asset is 8%, what is the value of Berkshire today, and should we buy the stock? All right, so again, we're dealing with a present value here. So we're going to start off using the formula we were just using, but then we're also going to use the Excel function, so you can see that. All right, so using the future value formula, or present value, sorry, take the future cash flow that we're going to be dealing with. Oops, 350. Update that. Put those backwards. All right, so when we're dealing with the present value, we take the future value and divide it by 1 plus our discount rate raised to the year. Right, 2 years from now. All right. So in this case, we're getting a value of $300.07. All right, so strictly speaking, if the cost is $300, should this be invested or not?
Yes.
Right, so the cost to have access to this future cash flow is $300. Right, so if the value is equal to or greater than that cost, we should be willing to invest. All right. Now we're going to use a time value of money function. All right. So we're calculating the same answer. We're just now using Excel's function to this formula that we're following. And this is going to be much more helpful when we're dealing with multiple streams of cash flows. All right. So looking at what Excel is, it's giving us all the information Excel needs in the order that Excel needs it. So very important that you follow this order. So the first Excel needs, another nice thing that Excel does is it gives us the definition of what we're dealing with, right? So before I open up the parenthesis, right, it's giving us the definition of what present value is, which is another really nice function about this. Right, so it turns the present value of an investment. In other words, the total amount that a series of future payments is worth now. Right, so it gives you the definition of the function as well as what you need to put into it. All right, so once you open parenthesis, now Excel is telling us what it needs. Right now it's highlighting the rate, so we need to put the discount rate in. So you use a comma now to move over to the next input, the number of periods, 2 years. All right, so here's an important distinction. So a payment is a reoccurring cash flow. We're just dealing with a single cash flow for now, so we're going to be skipping over it. And then we're going to be using a future value. Now notice what happens to the value being put out in Excel. Right, in absolute terms, we got the same answer, but it's giving us a negative 307 cents. So important thing to keep in mind when you're using a time value of money calculator, whether it's the calculator itself or an Excel function, is there has to be a negative sign on either the cash inflows or the cash outflows. Generally speaking, we're going to be putting a negative sign on whatever is going in these parentheses here, just so that our outcome is the expected positive values from these cash flows. All right, so we put a negative sign on our future value there. And that's getting us the answer that we expected, the $300.07. Any questions on using functions? Okay. All right, so let's look at this a little bit differently now. Now let's say that the price is around $325. If analysts expect the price to be $350 in 2 years, is it worth investing in right now? Right, based on the previous answer that we got, right? No. Right, we're just calculating the same question again. Only difference is the price we're comparing it. Right, so you should already know the answer, but good to practice this out. So with the formula, we get our future value, take the future cash flow, 1 plus the discount rate, raised to the year. Right, so we're still getting the same answer. We should get the same result with the function as well. So using the present value, we're putting in our rate. Our number of years. We're skipping over the payment, getting the negative sign on our future cash flow. $300.07. So if the price is $325, should we invest? Correct. Right, in this case, the benefit is lower than the cost. All right. Now we're going to look at the present value of a master's degree. So this is the average annual value of the master's degree we're looking at. I got the links here from the BLS over here for business and finance specifically. Oh, I forgot to include the link for what I posted, but you can still see it in the picture I linked in PowerPoint. All right, so the average, or not the average, the median weekly wage of someone with a master's degree in general, is $1,574. With the bachelor's, it's $1,334. Right, so very important to keep in mind when we're evaluating a cash flow that we're looking at, we have to evaluate the marginal costs and benefits. Right, so in this case, we're looking at the marginal benefit of differing levels of education. All right, so the value of a master's relative to a bachelor's is going to be the difference in the wages that we're receiving in them. Right, so we're not comparing the value of a master's relative to a high school degree. It would be another trade-off that we would be considering. Right here, we're looking at the marginal benefit of a master's versus a bachelor's. All right, so we see an average annual wage difference of $12,000, right? Basically another $1,000 a month. $1,000 a month difference between these two cash flows. So now let's take the present value of this cash flow. All right, so we're going to be using the present value function. We're using a rate. So what rate we use is going to be highly, or our answer is going to be highly dependent on what rate and number of years that we use. Right, so the rate we're using here is a 6% discount rate over 25 years. And $12,000 per year. So now we are using a payment, right? So the difference between the previous question and the one we're looking at now is whether or not a cash flow is reoccurring, right? So in the previous example, we were only looking at a single $350 payout in 2 years. In this current example, we're looking at the average annual difference between a master's and a bachelor's degree. All right, so that's what we're going to be using payment for. This is a reoccurring cash flow every year. So the average annual difference of $12,000. Right, so at that value, it prices the value of a master's degree at about $160,000. Right, so basically what that's telling you is if the cost for attaining a master's degree is less than $160,000 and you're using a discount rate of 6% and getting that benefit for 25 years, then you'll see that you can compare that trade-off. The cost is however much it takes to get a master's degree versus the benefit of roughly $160,000. Right, so there's a couple of things to keep in mind here, right? It's not adjusted for inflation. Nominally, right, wages tend to increase a bit with inflation, so that's going to change this over time a little bit. There would be a growth rate we would be putting into this cash flow. 5 years, it depends how long you expect to keep on working. If you expect to work longer than 25 years after getting this master's degree, say 35 years, right, then the value increases more. If you have a higher discount rate, say 8% per year rather than 6%, then the value is going to go down. Right? The inputs that we use into these functions are going to change the answers we get, but it still gives us the basis to evaluate the trade-offs between the costs and benefits. Right? The cost of a master's degree is how much you're paying in tuition. If you're avoiding working in order to pursue a degree, it's the foregone salary that you would have had while working. So those are going to be your costs, and you have the present value of $159,000. Interestingly, though, right, like I showed in that PowerPoint, the median salary for financial managers is around $130,000. Right, so let's actually add that in here. All right, so I'm just going to put 30. This is just rounding off memory. So typically with financial managers, that's usually be more for the graduate degree. Business and finance averages around 80. That is also rounding. It's both in the low 130s, 180s. All right, so when we use something that's more on a bachelor degree basis, typical salary around 80,000, graduate degree 80,000. All right, so when we're looking more specifically the field of finance, the spread increases between the marginal value of a master's relative to a bachelor's, right? So keeping the discount rate the same, keeping the number of years the same. Now the value increases for the master's degree to 640,000. Let's round it down a little bit, 639. Right, so this is one of the benefits of being able to apply the time value of money. It gives you an idea of how much something is worth, right? So in the case of attaining a master's, if we're using these values for median average or median salaries in financial management positions, right? The benefit is being able to attain those salaries relative to the benefit of staying at a bachelor degree and the average salaries associated with that. Any questions on time value of money so far?
That discount rate, the 6% that you found to get the present value of what a master's and a bachelor's degree is, what does that necessarily indicate?
Basically the opportunity cost over time. So this is just, in this case, the 6% here is an arbitrary number I'm using. So a couple of things going on with discount rates that we apply. So first and foremost, they should be above the inflation rate. Typical inflation has been, I think it's still averaging high 2%, even including this large inflation we've seen over the last year, over the last couple of decades. It has to include the opportunity cost of what you could be investing in. So for most people, that's going to be a mix of bonds and stocks if they're following the traditional portfolio allocation that comes with a lot of employer-backed investment policies. Within the bond market, that's usually going to be somewhere between 3 to 6%. Stock market somewhere between 8 and 12%, depending on how you define stock and bond markets and the time period you look at them. So basically, what this is here is a rough guesstimate of what sort of portfolio allocation somebody has over time that you'd be applying to their cash flows. So when we're looking at present and future value, what we're looking at are mere opposites of one another. Right? So when we're calculating the present value, we're doing the opposite of a future value. So we should think, what would we be doing to calculate the future value of the cash flow? So in the case of an investment, so say this 10% from our earlier example, if we have a 10% growth rate, that means we'd be discounting that cash flow back at, again, that 10%. So if over the course of your life, you earn an average of 6% based on a balanced portfolio between stocks and bonds, that would be the discount rate that you'd apply to cash flows you're dealing with in your own life. If you're invested in only equities, you'd use something between 8 and 12% as a discount rate you apply. That's a reflection of the investments that you're making over your lifetime. If you're making investments solely in bonds, it would be a little bit lower.
So everyone's discount rate in this case would be individualized based on where they've invested in their portfolio over
Pretty much.
time. Okay.
Yeah, pretty much. So when we're talking about discount rates, usually it's going to be from a company's perspective. And we'll see that's going to be based on their, largely it's going to be based on their issuance of debt and equity. And that's how we're going to be calculating the costs of capital for companies, is through basically how much their cost of debt is, what their cost of equity is, and then taking the weighted average of those values to get the discount rate that companies are using. When we're dealing with a person's individual discount rate, it's not as well established what it should be. But if we're still using the opportunity cost of those person's investments, which are the assets that they would be investing in over their life, then yes, we should still be using what the average rate of return would be on their portfolios.
Just a thought. This is another way to think of this. If you're financing the MBA or your MBA or MS with student loans, wouldn't the interest rate on the student loan be a good discount rate to use?
Yep, that is one way you could look at it. But it's kind of the perspective on costs and benefits of your life. So when I say the personal discount rates haven't been as well established, it's because there's kind of like points like that. So yes, there are costs to our financing, right? There's the cost of taking out a mortgage. So there's an interest rate with that. There's an interest rate on student loans. Costs we'll have to pay. People don't individually source equity. There has been discussion on students being able to have like an equity line tied to their future income streams rather than taking out student loans. So it gives a little bit more flexibility in their income repayments. But people don't have the same fixed cost or the same sort of external capital structure that companies do. So it's a little bit messy when we deal with personal discount rates. So you can look at it, strictly speaking, from the cost of financing the degree, but I think that doesn't include the opportunity cost of investing that money in what you would otherwise have put it in, which would be an investment portfolio. But yeah, that is a good point of consideration to think of.
Just to like be a little clearer on this. So like, is the rate in this example just basically if you take that extra money and you're putting it to work for you, so you're like that's the idea there with
Yes.
that rate?
Yeah, so when you're looking at discount rates, think of it as also right? Present and future value are mere opposites of one another. So if you're trying to figure out, what the value of the cash flow you're saving up over the course of your time is, that would be based on what you're investing that cash flow in. Right, so if you're investing it in a balanced portfolio between stocks and bonds, typical to a lot of base investment portfolios in something like your 401k, that's going to be a balance between stocks and bonds. Right, so then that would be your opportunity cost, is the foregone investment that you are putting, the foregone investment that would have been placed in that portfolio.
I have a quick question.
Mhm.
In regards to that rate, what if, so for me, for example, I'm using the GI Bill
Mhm.
for my master's program. So it's free. And I'm also getting money from the VA. So how would that affect opportunity cost when it's ultimately costing me nothing?
Well, so that's the cost and benefit aspect of this, right? So this is just getting us the benefit of the degree. All right, if we wanted to balance it out with the cost, we'd have to compare it to the cost of the degree itself, plus the opportunity cost of something like not working. So if you're working while getting this degree, then that opportunity cost of foregoing that income isn't a cost that you're incurring, right? So it's not something to weigh against this present value. If you're not paying for the degree, if you have a GA, if you have some sort of scholarship that's paying for the degree, again, that's not a cost you're weighing against this benefit. So when we're looking at the benefit of an asset, actually, this is jumping later on to NPV already. Basically, what we do is we take the present value minus the cost for accessing that present value. So what you just mentioned is the cost for access. And if that cost is zero, then you're just looking at the present values.
Okay.
So like I mentioned, personal discount rates are still not as clearly established. So this is kind of just a random guess. When we look at putting together discount rates, which will be when we get to WACC, weighted average cost of capital, it's a little bit cleaner of an explanation for a company. Any other questions? All right, so now we're going to look at a couple specific forms of cash flow streams. The first is going to be a perpetuity. So a perpetuity is a cash flow that occurs forever, in perpetuity. All right, so when we're dealing with public companies, one of the ways that is assuming that they're going to operate in perpetuity, which means that we can take a continuing value of a company. One of the ways we can value those companies is looking at their dividend stream. All right, so we're going to use Coke as an example. Let's say if Coke is expected to pay a dividend of $1.75 every year forever, what is the company worth? So valuing a perpetuity is fortunately pretty easy. It's just going to be the cash flow divided by the growth adjusted discount rate. All right, Actually, let me take out this one caveat that's adding something we don't want to look at just yet. No. All right, so when we're valuing a perpetuity, we just look at the future cash flow divided by the growth adjusted discount rate. So if we're paying a fixed dividend, there is no growth rate. So that would just condense to so the value of a constant perpetuity is just the cash flow being paid out divided by the discount rate. This formula is so simple that Excel doesn't, actually maybe it does, I've never bothered looking. This formula is so simple, I've never bothered looking whether there is a function in Excel to calculate the value of a perpetuity. Right, so when we're calculating value of perpetuity, we just take the cash flow divided by the growth rate of that cash flow. All right, now we're going to look at a little bit of what timing can do to the value of an asset. All right, so Coke is expected to pay $1.75 next year, growing at 2% per year. What is the value of this asset? All right. All right, so there's a couple steps that we're going to have to make here. The first is figuring out what the present value of the $1.75 is. All right, so we get that present value 1 divided by 1 plus the growth rate or discount rate raised to the number of years. Next year, 1 year. Now, all right. So we got the present value of that single cash flow. Now there's one additional step we have to make because this is perpetuity, right? This dividend isn't being paid out once, it's being paid out in perpetuity. So we're going to take that 7%, net out the 2% growth rate. That's going to get the value of this in perpetuity. All right, so what's going on here? Just by growing this perpetuity by 2%, we've increased the value from $25 to $32.71. All right, now we're going to change things one more time. All right, the company pays a $1.75 dividend this year, and then it's going to be growing at 2% every year thereafter. So basically what's happening is this $1.75 dividend was paid 1 year earlier. So it's going to be one additional year of 2% growth, growing forever. How much is that 1 year change going to change the value in this company stock? All right, a couple things to keep in mind here. Cash flows that have been paid out are not worth anything. The only thing that's relevant to a company's value are the future cash flows that the asset is expected to generate. All right, so we're not using this $1.75 as the value for the asset, but we're going to be using it to calculate the cash flows that are relevant. All right, so we're starting off with this $1.75 dividend being paid out. And we're going to be multiplying it by 1 plus the growth rate. All right, so in other words, what we just found here is the next year's dividend that now is relevant to the value. Right, $1.75, it's been paid out, it's no longer relevant to the value. What we did though is we took that $1.75 that was paid out, multiplied it by 1 plus the growth rate, and now this gets us next year's cash flow, next year's dividend. Now this and all future dividends after that year are relevant to this asset's value. So this is what we're going to be using now to calculate the perpetuity value of this company. So we're going to be dividing that by the growth adjusted discount rate. So just by moving the timing of that cash flow, we increase the value of this stock. Okay, and so this reflects the power of compounding, especially in perpetuity. Right, just by changing the timing of the dividend, we've increased this company's stock value. And that's what happens. The earlier you receive a cash flow, the more valuable that's going to be. So we started compounding that $1.75. We started growing that just 1 year earlier, and we added value to this company stock. Any questions on calculating values of perpetuities? All right, we got a couple minutes left here. I think we can finish up the annuity and we'll keep going with time value money next class after that. All right, so an annuity is a fixed cash flow or cash flow going at a fixed rate over a fixed time period. So a perpetuity is a cash flow going forever. An annuity is a cash flow over a fixed time period. All right, so in this case, the example we're going to use to calculate an annuity, it's going to be a future value annuity. Is let's say that between your own contributions and an employer's contributions, you're able to save $1,000 a month, so $12,000 a year. Invest in a diversified portfolio, expected to earn about 6.5% per year. What's going to be the future value of this portfolio? Okay. This is where retirement planning comes in. This is what time value money can be used for. Figuring out how much a stream of cash flows is going to be saved up to, compounded to, over the course of a lifetime. All right, so the first thing we have to get following the time value money function here in Excel is the discount rate we're applying. So we're going to be moving future value out over time. So let's fix our reference there. Then we need the number of time periods. We're going to let that move as we copy this over because we're changing the number of years that we're saving up over. And then we have our payment, right? How much we're saving up every year. And we're not changing that over time. All right. So if we save up $12,000 a year over 20 years at 6.5%, the value of that cash flow is $465,000. Right, this nominal value here, what we're going to be looking at is just how much we have saved up. Right, so future value reflects how much we've saved up and how much compounded interest we've earned on that savings. All right, so this nominal value is going to reflect just how much we've saved up overall. All right, so over the course of 20 years, we've saved up $240,000. But because we've invested it, because we're earning interest on this investment, it's compounded to $465,000. Right? So we can see, divide that future value divided by the nominal value, and we can get an idea of, how much of our portfolio is coming from our savings and how much is coming from compounded interest on that savings. And we'll see that over time, more and more of our portfolio value is going to stem from the compounded interest on our investment. All right, so we fixed our reference to the interest rates. Oh, I did not fix reference to the payment. We got to keep that fixed as well. All right, so now we can just copy and paste this across. All right, so just from going an extra decade, going from 20 to 30 years of savings, we went from 465,000 to just over $1 million. Right, so in other words, we more than doubled our savings, compounded with interest, without doubling how much we've saved up. Right, we've just gone another 10 years of saving. So as we can see here, our future value that's stemming from compounded interest has increased. We went from just under 2 to just under 3, oh, a little bit more than just under 3, to 2.88. In other words, 2.88 times of the portfolio's value is stemming from the compounded interest relative to how much we have saved up over those 30 years. And if we look further and further into the future, we'll continue to see that exponential growth over time. The more time we allow our savings to compound, the more the portfolio value will grow and grow exponentially.
Dr. Jansen,
Yes.
quick question. So if you want to factor in like inflation here, say if it's like 2%, do you just do like 6.5 minus 2%? So it'll be growing at 4.5, and then you do like the NPV of like say 60 years from now until now. That'll be how much you would really have. Is that right?
It depends what question you're really trying to go after here. So In other words, are you asking,
Like if you're
What-
saving like this same amount of money, this $12,000, and you're saving it for the next 60 years, and then you're thinking the average inflation is about 2% and your expected earning is 6.5%. Do you take that 6.5 minus that 2% and then you compound that for 60 years? And then you do the NPV of that money in 60 years to now. Is that like pretty much how much you would really have?
so that it's part of the step. So that's not adjusting for the cash flows changing as well. Right, so usually income increases at an average around the inflation rate. So what you're doing is adjusting the discount rate inflation, but it's not adjusting the income being saved. So yes, if we are assuming that our savings are staying at 12,000 per year, just pegging it that with inflation, then yes, what you suggested is how we would adjust for inflation. We would just net out from the compounded rate to get the real value.
Gotcha. So to make this more like accurate, you would probably like add like an inflation rate to your however much savings you have. So like 12,000 next year plus 2% of that would be how much you're saving, and then keep on
So
that. And then
the thing is, if you did do that, you're still getting the same answer.
gotcha.
So you're basically washing out the 2% you're netting from the discount rate by adding that inflation to what's being saved. So that's why people tend to ignore inflation when we're adjusting for time value of money, is it basically cancels itself out. So that's why for the most part, we're using nominal values. All right, so a couple other things to keep in mind. So I'm just going to copy and paste this over. Don't know what's so large in that last section. All right, so now we're going to play around with the discount rate a little bit and see what happens here. All right, let's say that we focus, rather than having a diversified portfolio across stocks and bonds, it's more focused in something like bonds. Oh, I gotta update these links here. All right. So if we went from a 6.5 to a 4%, look at what's happening for our portfolio savings over this time. All right. So in the initial example, we went from 465,000 to 7.8 million to 350,000 and 2.8 million. Right. And that only happened from a 2.5% difference in the compounding rate that we're applying to these cash flows. Small changes in compounding rates over the course of a career, over the course of a lifetime, can compound to tremendous differences in value. Right, so this is part of the reason, especially early on in someone's career, that people are advised to wait a little bit more towards equity. Right, equity is riskier, but over the course of a lifetime, it tends to balance itself out. So again, depending on what time frame you're measuring the stock market, what stocks you're including in your definition of stock market, the stock market averages between 8 and 12% per year. All right, so sticking at the lower end of net equity, we go from 549,000 to 15 million over the course of 6 years. Again, keeping how much we're saved every year the same. We're still saving 1,000 a year, but we went from this initial example of 6.5% from 465,000 to 7.8 million to 549,000 in 20 years to 15 million over 60. All right, so this again shows the power of compounding. Just a couple percentage points can make a big difference, right? So let's go look at the higher end of stocks, of the stock return. If we go to the higher end stock return average, right, there is a lot of evidence to suggest why we shouldn't expect this. Right, the average returns we've seen over the last decade have been particularly high, but it goes from 864,000 to 89 million. Right, so small percentage point changes in the compounded value over the course of a lifetime really add up to a significant difference in value. And this is why a lot of financial advisors typically suggest that when people are starting out their career, they wait a lot more towards equity, because over the course of a lifetime, on average, stocks earn significantly higher returns relative to bonds and other assets that people have access to. And this is why the power of compounding is so much. So realize I'm starting to cut it over time. So next class, we're going to pick up, keep on going with time value of money. We're going to be doing some more examples here. Finish off this page that we have here. I'll add some more examples as well. So I'm going to save this and get this posted on D2L. Do we have any questions before we get going?
Do we have any homework?
The problem set, actually, great question. Yeah, the problem set. So that is posted in D2L under the problem set section. Let me just download it real quick, make sure I updated. Yeah, it looks like it is all set up. Oh, actually, I'm going to take out the pro forma section. Have to take that out. So yeah, there is the problem set you can start working on, the time value money. I'm going to delete the pro forma section from it real quick. I'll get this uploaded right now. So the problem set in detail is what you're going to be working on. I do suggest that you work on that as we're going through class. It's going to be a lot easier to get through the problem set as you work on the problems after we cover the material in class. So the section you should work on after tonight is the time value of money tab. And then after next week, you can get to discounted cash flow to risk and return. Actually, you could probably start discounted cash flow if you wanted to after what we got through. But that section will be a lot easier after next week. Any other questions?
So for Capital IQ, do we need to just be on the lookout for the email, or I mean, what do we need to do
Yes.
about that?
Yes, I contacted Capital IQ again today. They did send out the emails. My guess is Proofpoint blocked you from seeing it and deleted it. So basically, keep an eye out for either Capital IQ and look at your Proofpoint emails in the morning. They come very early in the morning and show you any emails that were blocked over the last 24 hours, and you have 1 day to release that email from Proofpoint. So that's my guess on why some of you didn't receive Capital IQ emails.
And that goes to our MTSU email, or do we have to go to Capital IQ and create an account?
So you're going to get a link from Capital IQ to your MTSU email. And so you'll follow that link to finish setting up the account.
Got it. Okay, thanks.
Dr. Jansen, did you
Yes.
state anything about us having to do weekly discussion boards?
Yes, but that's not going to be until the later half of the class. So that's going to be based on the research papers that I have posted.
Okay, thank you.
Yep. So I strongly recommend getting started on the problem set. I'm going to update the file after taking out a section. We're not going to be working on that as much, and you're going to have a separate class that'll cover that in more detail. So I'm going to get this updated and posted now. So tomorrow I'd recommend starting on the problem set. Read through the course notes, short condensed version of the class, and read, what is it, I think it's the $500,000 haircut or something like that, $300,000 haircut. So that's posted in articles for the class in D2L. I'll send out an email reminding you of these things as well tomorrow. It's late, we're all tired. So yeah, I'll send an email. Any other questions?
Yeah, Dr. Jensen, so the Capital IQ email, is it going to like our junk mail, like inside Outlook, or is it going to pop up like just on the regular mail?
It should come to you, but it might be stopped by Proofpoint. That's MTSU's defense against spam. The problem with Proofpoint is it only gives you 24 hours to access the email they're trying to block from you. So if you don't release the email from Proofpoint within 24 hours, it's deleted. Yeah. So keep an eye out from an email either from Capital IQ or Proofpoint. And just keep an eye out. If I hear back from them that they've sent it, then I'll definitely confirm with you all that it's out. But they have sent at least one round of emails so far.
Okay, because I was about to say I don't have an email from Proofpoint, so that just means they just probably haven't sent the link.
The Proofpoint emails too are also deleted with 24 hours. You basically, yeah, it's a really frustrating system. You don't have much time to react to those emails. So just keep an eye out for them.
Because you get access to technically inside Outlook, at least on my app, to like deleted email, I guess. And nothing's in there either.
So
and
Proofpoint
nothing's
is kind
in
of,
there either.
it's an external app that basically filters our emails. So we don't have access to any of the emails that are within Proofpoint until we release them. So if the email is contained within that Proofpoint blocker, it's deleted and it's not going to show up in your email at all. It is a frustrating system, and I'm sorry we're dealing with this. I didn't realize this may have been happening. So hopefully they'll get that email out. Just keep an eye out for Proofpoint or Capital IQ.
I just wanted to double check, Doctor. So the email would be located inside the junk emails portion or the deleted?
So no, it should be in your main email. So you're either going to see Capital IQ or Proofpoint. Let me share screen with my email again so you can see that Proofpoint email.
Yeah, I'll probably take a screen capture of that.
Yep.
Thanks.
So this is what the Proofpoint emails look like. They're sent out every day in block emails that are tracked as external and might be like spam or phishing or something like that. You have to release an email that's sent in here within 24 hours, release and allow sender. If you don't do that, they're automatically deleted and are never touching your inbox. So you won't see them in junk, you won't see them in trash. It basically, it's like they never existed.
Yeah, I definitely got those emails, but I just had no clue what they were.
Yeah, I got it. I didn't know what it was.
Yeah,
Yeah.
they started this, I think a year or two ago, because we had some people who were following very fishy links, and they should have been touching them. And this was their response to that. So it is frustrating, and I'm sorry y'all have to deal with this. So keep an eye out for this Proofpoint email. It's either going to be in there and you release it and allow sender, or you'll get an email from Capital IQ.
And for the one that we're getting, we're just gonna click allow sender on everything in there. Like we're just gonna accept everything, correct?
From Capital IQ.
Okay, so it's gonna
Capital
say
IQ.
from and then at Capital IQ.
Yes. Yeah,
All right,
Capital
perfect.
IQ will be in the name. Let's see, yep. So email I got from them. It might be SP Global. I'm sorry.
Okay,
That's
perfect.
the company that owns Capital IQ. So
All right.
SP Global might be the other email you'll see. All right. Any other questions?
A quick question about the problem set.
Yep.
So those are due before the next class.
No. I just suggest that you work on them as we're going through the materials so you don't forget what we've talked about. So let me double check the due date here.
It's like 9/21, I think.
Yeah, it's not until September. Yep, you're right. September 21st.
I think it might have the wrong year.
Oh, I did update. Every year I miss updating the year. I had the correct days and month. I always forget the year. I did update the syllabus to get 2022. It took me a couple rounds of editing the syllabus to realize how many years I missed. I don't know how I make that mistake every time, but yeah, I updated the years. All right, anything else?
What kind of tea did you drink earlier?
I think it was like a chamomile and vanilla.
Is it like tea for energy?
No, not at night. It's just like a herbal tea that helps with like a sore throat.
All right, cool.
That's
Yeah,
pretty
we're
good.
glad. Hey, the whole class is glad you came back from that COVID. You know, it could have took you out. So
Yeah.
we're
Me
happy to
too.
hear.
It lasted a couple weeks, but I'm glad to be here.
Yeah, that's tough, man.
Yeah. All right. Well, this is a great class, and a lot of you are asking questions. I love it. Really appreciate that. The questions. If you have any comments or questions, you can email me, post on the discussion boards. But that'll be it for tonight. Hope you all have a great evening.
All right, thanks. See y'all
Yep.
later.
Thank you.
Can I,
Thanks.
Benjamin?
Thanks.
Bye.
Bye.